It is May 8th and it is Happy Mother's Day, or it is Mother's Day. So happy Mother's Day to all of the families, all of the mothers out there around the world. I hope you're enjoying your day. I hope you are enjoying your time with your loved ones and everyone is showing appreciation for what you do inside as well as outside of the home. With that being said, we got a topic that we need to discuss. We need to talk about what the stock market is doing, and how as an investor trying to build wealth, we can take advantage of opportunities like we are seeing. Over the last 4 months, things have been difficult. Unless you are shorting or betting against the stock market, you have most likely been down over the last 4 months. And so I want to give you a couple foundational ideas that I am thinking about and that I keep in the back of my mind whenever I am seeing events and the stock market go through this type of crisis, if you want to call it downturn to be more specific, and how to take advantage and hopefully come out on the other end in a much better place. But with this, as I always start every single episode, every single show, this is the journey for tomorrow. So the journey for tomorrow begins today, and that basically means that the work that we put in today is going to allow us to have a much brighter future for tomorrow. And so, I only do these shows just to kind of share with you some of my experiences, and by no means do I have all of the answers, but I just want to give you something that might brighten your day. And so let's jump right into it. So these are the foundational thoughts that I need you to have. Foundational thoughts, foundational ideas that I need you to have a belief in. Because if you don't believe these foundational ideas, then it's going to be very hard for you to align with kind of what I'm saying throughout this discussion. If you have betted against America over the last 80, 90 years in the stock market, you would have lost. Now, there has been periods of time within that 80 to 90 year window where the stock market has been down. But if you look at where the stock market was 80, 90 years ago, 70, 60, 50, you can kind of keep taking it by 10 to 5 year chunks, however small you want to go. You would have been ahead if you were to invest 5 years ago, 5 years prior to that, 5 years prior to that. Now, there are windows inside of that 12, 24 months where things might have been choppy, moved sideways, possibly even declined. But 9 times out of 10, 8 times out of 10, in 5 year window, the majority of individuals and investors and those who consistently do a DCA, dollar cost average, into investments are ahead than where they were 5 years ago. A great way for the average investor to get ahead, if you are not involved, if you do not follow the stock market on a regular basis, the best way that you can possibly get ahead is using ETFs, index funds, mutual funds to kind of beat the market. And I'm going to talk about that and give you some ideas and some concepts and how you can use that to better your returns and see better upside and wealth building in the future. A big one that is overlooked a lot is the discipline that you need within your own finances at home, within your own 4 walls, whether it be your wife, your husband, your children, a understanding and a mindset that we have to control certain variables that we can control. And if we don't have that discipline, we can't take advantage of opportunities that we are seeing right now. I am calling this downturn an opportunity. One of the biggest reasons I'm calling it an opportunity is because I am a late investor, and I want to talk to the individuals who possibly are just now getting involved in the stock market and haven't been investing for a long period of time. How downturn such as this gives you the opportunity to leverage in even more now, because you're getting things on what the majority of many people have always said. When the stock market pulls back, you're getting the U.S. on sale, the stock market on the discount. But I want to kind of talk and how that helps you in the long term. And then the last thing that you can do, and this goes into a little bit of the discipline of your finances within your 4 walls, and that's going to be being a consistent investor. And so a consistent investor is someone that can consistently put money in month after month, quarter after quarter, whatever the case may be. You want to be able to invest that money on a consistent basis so that then that portfolio can naturally grow over time, reinvesting your dividends, reinvesting any type of money that you get over the long term so that portfolio can continue to grow. So the first thing, and that's going to be the betting against the United States. In 1957, the S&P 500 expanded. So prior to, it was about 90 companies. In 1957, it expanded to the largest 500 companies within the U.S. And so, looking over the S&P 500's track record and whatnot, I was able to see 39 corrections. And I'm calling a correction that is anything over a 10% decline. And over the last 72 years, we have had 39 corrections. And so what that basically means, every 1.85 at every 2 years, basically, we are seeing a 10% or more correction within the S&P 500. I'm only speaking on the S&P 500. However, the NASDAQ and Dow Jones Industrial kind of go hand in foot with each other. So you can just kind of follow and assume that it's going to be a similar trajectory for the Dow Jones and the NASDAQ. But basically, every 2 years, the stock market is going to pull back somewhere a little bit over 10% and maybe even greater. What is interesting about that, in every single pullback that we have seen over the last 72 years and since the stock market has been higher, or since the stock market has been open, the stock market has returned to higher levels in time. And again, doing this research and just kind of looking over, I found out that the S&P 500 actually crossed 1,000 back in 1998. And so for every dollar that you were to have put in the S&P 500 in 1998, it will be worth somewhere around $4.80, $5 into right now. Because the stock market back in January of January 4th, it hit an all-time high of 4,800. Not to mention, if we went through a downturn in the dot-com bust, we went through 07 to 09 downturn, and we still are seeing all-time highs. So this is basically, and what I just want to bring to your attention is, when you bet against the United States, you have been a loser in the stock market. Now, again, from 1998 to now, from 2003, 2002 to now, and again from 2007 to 2000 and now, all of those time frames are over a 5-year period. But that window, the 2000 to 2003, that 3-year period, that 2-year period, depending on where you actually break down where the correction started, you would have been moving sideways. You would have been negative. But in time, and again, 07 to 09, in that window, the stock market, Dow Jones dropped from, 13, 14,000 down to somewhere around 6,500. You would have been a loser if you were to have taken your money out. But you don't have to do that. And those are the opportunities where you can leverage in, be able to invest even more dollars to see that upside in the future. So that's the first thing, betting against the United States, okay? We should not be betting against our U.S. companies, because we have shown time and time again that we are, consistently improve on our technology, consistently improve on our margins, find new sources of revenue, and continue providing value to the American people and globally across the world. So, okay, now the question I have, Aaron. Hey, I am a beginner investor, and I have no idea where to invest my dollars. And so, the first thing that I will say to you is the average person can track the stock market just by using an index fund, a S&P 500 index fund, a NASDAQ, a Dow Jones index fund. And what this basically means is 30 companies within the Dow Jones, the 500 companies between the S&P 500. And I don't know actually how many are within the NASDAQ, but there is a index fund that you can purchase that basically puts all of those companies into one index fund, one stock symbol. And so when you purchase shares of that stock symbol, you are basically putting money in all of those companies within that index fund. And so this gives the average investor the opportunity to invest with America. And I keep wanting to emphasize this investing with America, because investing with America, again, has clearly won over time. And so once you kind of get your feet wet and start investing and seeing how the stock market works, seeing how, on a quarterly basis, you're getting earnings reports, and you're seeing how companies are doing on a quarter-to-quarter basis, on a year-over-year basis, how companies are talking about future things and future concepts and products that they want to start selling in the future. You begin to get your feet wet and start seeing this. You're going to want to most likely diversify into something a little bit more specific. So what I have actually done, and my wife and I have actually done within our portfolios, is we began to do what I call is sector diversification. And so you have 10 different sectors 11 different sectors in the stock market. I'm not going to go over all of them, but some of the ones that I really like are the consumer discretionary, consumer staples. I like technology. I like in materials, and then I like industrials. Those are some of the big ones, but there are many more. Energy is one. Real estate is another. Communications. And I said I wasn't going to name all of them, and I'm naming all of them. I'm trying to think. Utilities. There's got to be a couple out there that I'm forgetting, but yeah, either way, you want to begin to start finding different sectors that you believe in. And so, for a good one for me that I really like is the consumer discretionary. This has your Targets, your Starbucks, your Apples in it, companies that you shop at a periodic basis, your Costco's, your Walmarts, McDonald's, Burger King, Pepsi, Coca-Cola, General Motors, wherever consumers kind of spend their discretionary income, there's a sector called discretionary income. And so you can begin to find index funds, mutual funds, or even ETFs that track different sectors of the market. And this is going to allow you to get some type of diversification in the stock market over and beyond just investing in the S&P 500. And so the most important question that I always ask myself when I'm starting an investment in a particular sector is that sector going to be around in 5 years? Is it going to be around in 10 years? Because the whole concept of investing is putting dollars in and letting that money sit and marinate over time. And so you don't want to put your money in a sector that you don't see has any growth in the next 5 to 10 years. You want to put your money in, for instance, a sector that is not within the 11 investment sectors, but like electric vehicles. You can see that sector or that industry starting to grow now in 5 to 10 to 15 years from now. That sector is possibly going to be a much larger than it currently is today. And so putting money in ETFs and mutual funds and index funds that track electric vehicles and those that are involved in electric vehicles might be a great opportunity, because that value is going to be higher and increased in the next 5 to 10 years. Another very sleeper that I personally didn't even realize is the power of reinvesting your dividends. And reinvesting your dividends is going to really allow you the opportunity to see that additional jolt. It's amazing. I was listening to Warren Buffett one time, and he was talking about if you were to have put $10,000 in back in the 1950s and just reinvested your dollars from 1950 to now, he was saying that you would have somewhere over $50 million, which was amazing and mind blowing to me. But the power of reinvesting your dividends, the power of getting paid on a quarterly, biannually, and annual basis from your favorite companies is powerful and can really help launch those portfolios to a much higher level. So let's talk about at home, because you need to be able to control the four walls of your home, because if not, you can't take advantage of opportunities that we are seeing right now. Inside of your four walls, no. Let me reverse this. Reverse it. This type of market, I'm going to go into. I consider myself somewhat of a late investor, and other people will laugh at what I'm saying, and others would agree. Starting from 25 years old, doing $100 a month. Let's just say 25, $100 a month to 65, you will have $1 million in your portfolio. Okay. And so with that long term, with that amount of time in the market, it allows you to put in a smaller amount of money and still get that significant upside. You push that back to from 35 to 65, $100 a month. That's only going to be somewhere around $300,000, $400,000. So you can see the power of 10 years just on $100 a month. And so when I say that this type of market favors the late investor, what I mean and what I want to be very clear about is when you see the stock market have these significant declines, 10+%, 15, 20+%, you are being able to buy back time that you have missed in the past because you weren't investing. And so for those who are investing late in their lives, late in their careers, you want to look forward for in markets like this and try to put in as much money as you possibly can, as long as you can maintain your lifestyle and your household without having to pull that money back out. And so that's where I say the discipline over your household expenses is going to play a key role, because if you have, the credit card debt, if you have the vehicles, if you have the insufficient savings, when you have outside events within your lives that pop up where you need additional dollars, you don't want to have to be forced to sell some of your investments. You never want to sell your investments until you are ready, until the time is right. If you are forced, say for instance, you put in a lot of money, you put in your stimulus money over last year and whatnot. Yes, you might have seen some upside, but if you are selling right now in this market, you would have lost some of that money that you would have made, and therefore this wouldn't be an ample right, or this wouldn't be the right time in order to take advantage of selling some of your investments. And so you want to be in a position where you have enough savings in the bank account in order to withstand some of these markets. The question is, and one of my favorite songs, can you stand the rain? And so can you stand being in a market like this that is moving sideways, that is declining, and still be able to have that mental fortitude to continue putting money in on a consistent basis? And the best way to give yourself the opportunity is to minimize all of those variable expenses, the vehicle loans, the credit cards, the student loans, things of that nature. Even if it's at 0%, that doesn't help that monthly payment is due every single month, and money is needed in order to fund that minimum payment. If you didn't have that minimum payment, if you were to basically add up all of your minimum payments in your life and just invest that into the stock market, you would be significantly wealthier in 5, 10, 15 plus years. I am on a plan right now from April 2018 to December of 2020, I paid off a significant amount of debt. I was paying off somewhere around $4,000 to $5,000 on a given basis, which was well over $100,000 in monthly payments when you add up, or not $100,000 in a monthly, but or cumulative $100,000. What I am trying to do is see what it feels like to put that much money to myself and my family. And so that's why I'm putting in $4,000 or $5,000 across different investment accounts, brokerage, custodial, retirement, crypto, because I want to see what happens when I put money and pay myself for my future wealth, instead of paying it to Ford Motor Company, to Verizon, to Chase for my credit cards, things like that. I want to put that money that I was already consistently paying to others and pay it to myself. And so that is the plan, and I encourage you to look at and go to a compound calculator or investment calculator, and like I said, add up all of your minimum payments and put in there 5 years, 10 years with that minimum payment amount, and see how much wealth you would have built over that time frame, and try to use that as motivation in order to get out of debt and begin building wealth for yourself and your family. All right, the consistent investor. So, many folks always hear that these are a couple, phrases that are very prevalent out there. But, who wins in the stock market? You always hear this concept that time in the market versus timing the market. Very important key. And what that basically means is that you don't have to try and time the ups and the ups and the bottoms, the downs. You just need to be in the market and be able to put in a consistent amount of dollars over a long period of time, and you will outperform what the market does. You reinvest your dividends, you stay consistent, and you stay true, and you don't pull or don't get nervous when the stock market declines. That is going to give you the best possibility to be successful with your wealth building journey. My favorite, and what I always like to say is, and I even started off this video with, the journey for tomorrow begins today. And so what I want to see in the future, what I want to be, where I want to be in the future, all has to do with the decisions and the concepts and things that I do today in order to give myself and my family a better foot forward for tomorrow. Tomorrow comes quickly, and today doesn't last long. So understanding that is going to give you the best possibility. And when you have to make those crucial and tough decisions as to whether or not to do this or do that, understand that you put in the hard work and the sacrifices today that's going to allow you to enjoy all of that tenfold tomorrow. And I promise you, that your future self will say thank you. And so with these weekly discussions and with these weekly talks, I always give you an update on or my wife's and I personal portfolio. I talk about four different concepts on a weekly basis, whether it be our ETF brokerage account, retirement, crypto, or custodial accounts. We have a son and we are expecting a daughter here in the next couple of weeks. And so I always like to find different topics to discuss on a weekly basis in order to give you guys an opportunity of, again, just different things I'm thinking about and what I'm talking about. And so I'm going to give you a portfolio update on our brokerage account. And so at the end of this past Friday, our brokerage account was sitting at $84,000. Last month, for the month of April, we invested $3,300 over 10 different ETFs. 11 different ETFs, excuse me. As you can see, we are down significantly. Just for the last month alone, we are down $10,000. So, I am not sharing or I'm not saying anything that, I'm not experiencing. I am experiencing a significant downturn within our own portfolios. That doesn't include the retirement accounts. It doesn't include the crypto, nor does it include our son's custodial account. All of these are negative. So we are not prone to, not experiencing this negative market like you and so many others. As you can see, the value gain. Personally, I like to track the dividends. So back in quarter 2 of 2021, we got paid out $14 in dividends, which is not anything meaningful, but it's just something that I like to track because over the course of the years, I got 30 plus years to continuously invest, and I just like to see that difference and that upside on an annual basis. For instance, for quarter 1, if you were to watch some of my older videos, you would have saw that we got dividends somewhere around $80 for quarter 1 of this year, and quarter 1 of last year, 2021, we had just received only about $10. So almost eightfold in dividends over the course of a year of consistently investing this time or this amount of money within the ETFs that we have decided. Our next goal is to get our portfolio to $200,000. And again, as you can see, our portfolio hit $100,000 back in November 4th. And every single month we have been investing dollars, month in and month out. And so as you can see, if in November we were at 100,000 and right now we're sitting at 84,000, and I'm telling you every single month we have been investing money, that basically means our portfolio is down and is losing value. Again, we are not short-term investors. We are long-term investors that believe that the stock market is going to be higher in time, which is why we are continuously investing and why we are continuously trying to put in as much money as we possibly can right now. So that then again, in 10 plus years, when we are 40 years old, 45 years old, hopefully this account can be significantly higher and we can be able to start to live off the fruits of our labor. And so with that being said, please take a look at one of the videos that I just did last week. It's on ETFs and crypto and talking about the passive income and how you are or how I am using crypto to create some of that passive income on a weekly basis. Crypto pays out on a weekly basis, and that might be of interest to you if you found any of this interesting. If you found value in this video, please consider sharing. Thank you so much. Give me a thumbs up for the video, and I look forward to seeing you at another one. Have a good one, and happy Mother's Day to everyone. Bye-bye.